Hey team, Ben Nash from Pivot Wealth here, and today I'm running through the investment and property market update for January. Look, guys, before I jump into the content, please don't rush out and make any life-changing decisions off the back of what I cover. I strongly suggest you seek out personalized advice from someone with a magnificent beard before jumping in. If you're making big investment decisions, you should be thinking about doing that anyway. So, guys, look, in terms of markets and updates, look, in the news, we're seeing the big factor is tech shares slowing their driving market disruption. We've seen a big cooling off in the US that's sort of pushed wobbles through global markets and definitely the Australian share market as well. And it's got a few investors nervous. So I'm going to dive a little bit deeper into that. But that's probably the big headline from the last month. We're also seeing crypto shares tanking, although we've seen a bit of a rebound in the last week in particular, still well off the previous highs. But yeah, I think a few people sort of getting back into the market. And as a result, we are seeing a bit of a recovery there, which is good. Bit of opportunity there as well for people that are that way inclined. And yeah, I think something to keep an eye on over the coming month in particular. We have seen a bit of a slowing of the property market as well. So partly as a result of a little bit of an uptick in interest rates, I think partly as a result of more properties coming onto the market and a few people taking profits from some of the previous price rises that we've been seeing. But absolutely, there has been a slowing of the growth in property prices, although in most states, and I'll get into the detail in this, in most states, the property prices are still advancing. The interest rates are increasing, as I mentioned, and the Omicron, certainly in Australia, we're seeing a peak in most major capital cities. Thankfully, seeing a bit of a decline. It seems that the uncertainty is subsiding a little in terms of the impact of Omicron on the broader economy. And yeah, definitely a good thing for investors. So look, in terms of the property market moves, I've pulled out the stats from January. We've seen the Sydney property market has increased just slightly to 0.6 by 0.6% rather. So still positive, but only just, and certainly a long way from some of the growth that we were seeing in the back end of last year. Melbourne, 0.2%, so pretty similar story. Gold Coast and Adelaide, both up 2.3% in the Gold Coast and 2.2% in Adelaide. Sort of ties in with a lot of investors looking beyond the Melbourne and Sydney markets, and particularly investors from those markets. So still seeing some growth. In my view, there's probably a bit more to run in those markets. Perth is coming up as well, and the index of the 5 capital cities that are there is an average of increase by 0.8%. So still pretty good for just 1 month's time, especially if you think of median house prices around that $1 million mark. You're looking at a decent chunk of change, but obviously a bit of a ways from where they were. The share markets and crypto markets. So we've seen the ASX has gone down by 6.4%. The S&P 500 has gone down by 5.2%. The NASDAQ has gone down by just under 9%, so 8.98% in the last month. And the crypto index is still down 20%. It was looking much worse a week ago when I was running these numbers, but it has recovered a little from there. Still down, potentially some good opportunities. It's something that I've personally been thinking about in the last little bit. Our investment story of the month, interesting one, New Farm. They're a big chemical company based in Australia, but with operations around the world. I'll have a bunch of different chemical patents. It's up 15% in Jan. Was actually up a bit more and has cooled off a little bit. And a big driver of that is the massive uplift in their revenue forecast, $4 billion in growth in the revenue over 2022, which is forecast. And yeah, I think definitely one to watch there. In terms of market watch and what you should be thinking about, obviously we're seeing borders opening up. So very welcome news yesterday in the Australian share market. Saw that international travel is back on. Boom, I'm hitting up the Qantas site as we speak, trying to figure out when I will jump in a plane that's going to go over some water somewhere. Pretty damn exciting. And that has had a huge impact on markets. We saw a big uptick yesterday. The market opened down and then recovered really strongly as a result. So, fingers crossed that continues. And I think that as the world starts to reopen, that the tourism and travel is a massive sector across the world, and that flows through to the entire economy. So I think it's got to be a positive thing alongside all of the other stuff that's going on in markets. Tech wobbles, though, that is quite a concern. We work with a lot of people that work in technology, and a lot of them copped a bit of a hit as a result of those wobbles. It's the world is powered by tech, right? So we've seen huge upticks, and in fact, there's probably an argument that some of the tech prices were a little bit overblown, which I think is what has investors spooked around this. Interesting to see how that plays out in the next sort of month or so. Certainly a good reminder to be on top of your strategy when it comes to your investing. And if you do work for a tech company and have a chunk of your wealth or shares in that company, to just be rock solid with your planning. Interest rates is another thing that's impacting. We're still seeing, and I'll get into the US data, but still seeing inflation higher than what the reserve banks and stuff over there would want to see. So so a little bit of upward pressure on interest rates on that front, which then has a downward pressure on economic growth. The Australian economic data that we've seen inflation has been pretty steady in Oz, which is a positive thing. Not increasing is definitely good. The economic growth has slowed, but is still increasing really strongly. 3.9% for the last quarter from 9.6% in the previous quarter. Unemployment is coming down. So the unemployment rate is at 4.6% compared to 5.2% from the December numbers. Employment growth is up 2.7% from 0.7% in December. So we're seeing strong growth in the labor market, and that should put some upward pressure on wages, and then that will flow through again to the economy. That being said, there has been a bit of commentary come out in the last month from the RBA, and how effective this actually could be, I am unsure, but they have said that they don't want employers to be pushing wage growth because they know that that's going to put a bit more pressure on inflation, which in turn puts pressure on rising interest rates. So it's all obviously pretty all interrelated, but it's hard to see with the unemployment rate going down and employment growth going up. I know that we're hiring at the moment, and I'm seeing from the candidates that we're talking to in the market, there is upward pressure on wages for sure. China's growth, 4.9%, down from 7.9% last reporting. And the Australian dollar is buying 72 US cents, which is down from 73. That continues its downward trajectory. So pretty good if you've got USD denominated assets. Not so good if you're looking to invest over in the US, or if you're thinking about maybe jumping on a plane anytime soon. But reasonably steady, but still trending down. So again, a one to watch there. U.S. economic data in the great US of A, we're seeing the unemployment rate again falling, similar to Australia. Spending by consumers is steady. Their inflation is higher than it is here, and it remains elevated, which the Fed is quite concerned about. And interest bond rates, partly as a result, I suppose, are increasing. So I know that they're keen, and their commentary shows that they're keen to not have too much upward pressure on interest rates, but they're also very concerned about the potential for inflation. So, we're seeing a bit of competing pressures there. Trends that we're seeing. So one of the big trends for investors is that off the back of the markets cooling, that almost 10% in the last month, that there is a bit of an opportunity to get into the market with some more value than what we've been seeing in the recent past, which I think is good. Personally, I'm enjoying that. And we're seeing that more for investors as well. Obviously, we're playing the long game with this stuff, I think, or certainly that's our philosophies around investing. But, when you can pick up something that's a bit better value than it was last month, that's a positive thing as well. Tech workers are nervous. We're seeing a lot of paper losses. We are working with a handful of people that have been riding the wave for a little bit. And I think it's easy to fall into that trap of thinking that the markets will just keep going and going and your company's good because it's got the good snack station or whatever. But the market's putting that to the test at the moment. So it's got a few people nervous. And I think it's definitely, again, like I've mentioned at the start, highlighting the importance of having a solid plan around that stuff. Investors are concerned with the market declines, both in tech and generally, and the slowdown in property. The property market activity has increased while the growth has slowed. Seen huge amounts of new listings coming onto the market, which I think is great for property buyers, probably a little bit less good for property sellers, although for the property sellers are making boatloads of money at the moment because the market has run pretty hard. So, it's not like they're going without supper, but for buyers, having a bit more choice, a bit less competition for the properties that are out there means that your ability, if you've got a good strategy and you're patient and you're committed to finding the time to get the right property, that you've got more of a chance of doing that at the right price. Sydney, Melbourne, property buyers, I touched on this at the start, but they're looking interstate more. In my view, I think that Brisbane, Adelaide and Tassie are probably the ones to watch in the next 12 months. That I think that we'll see more and more activity, as well as probably some of the regional areas where Sydney, Melbourne prices have just become outrageous beyond the reach of some people. I think there's still a lot of good value for long-term investors there, but I think for some people it's just simply a numbers game that it's hard to spend the $1.5–2 million that you need to get into the market in some of those states. So I think that trend will continue. In terms of some of the hacks and mistakes to look out for, so the client story of the month that I wanted to start with was an individual that with an income of $115,000. She had savings in the bank of $220,000, but only saving at $5K per annum. When we scratched the surface on that, realized that there was the opportunity to boost that savings number pretty considerably. But the big barrier for her in making that happen sooner was that there was just no motivation because there was no clarity on targets, and the frustrations or the challenges that she was facing when it came to see us, she was feeling a bit stuck, but had the faux foo, like the fear of fucking up, basically the fear of making a mistake that was going to, she wanted to put that chunk of savings that she had to work, but didn't want to do the wrong thing and end up blowing up her cash. So she was really feeling stuck. And because of that, there was no goal or no objective for her to be following. And therefore, she had no motivation to actually make it happen. She was unclear how to put that money to work, and what she wanted was a pathway to a property investment. So what we ended up doing, or what she ended up doing or choosing to do as a result of going through that planning process, was purchasing an investment property around $900,000, then looking to build or rebuild the emergency fund to where she wanted it to be. From there was with a view to investing spare money into a share portfolio, because she had the emergency fund ticked off and the property, which had some nice tax deductible debt attached to it. And the result, the net impact of those strategies was she was down by $6K in year one, partly as a result of funding the $45,000 in costs to purchase the property that she wanted. Then by year 20, the upside though was just under $1 million, so $987,000, just by making a couple of, well, they're big but seemingly small tweaks now, equipping herself with the knowledge to give her the confidence to take action with this stuff. $1 million better off over the coming years. So goes to show the power of educating yourself and being on the front foot with this stuff so that you can actually take some action to get some results. Our client challenge of the month, working with a client at the moment that had a chunky 7-figure sum in a tech company, a listed tech company they had built that up over a period of time working with the company, and we went through the planning process, decided to sell down a big chunk of those because we recognized that they were very close to the point of having financial freedom in place, financial freedom, like enough money to cover the ongoing living expenses that they wanted. Obviously, we all aspire to more, and these guys didn't want to retire, but realized that by taking some profits, that they were going to be super close, and then had complete freedom in terms of what they did post the here and now, essentially. In that time, unfortunately, the share market for the tech shares in the tech company they worked with had declined significantly. So they're looking at this huge paper drop, and we're sort of oscillating between what do we actually do here? Do we suffer the loss, capitalize the shares, sell down the shares and capitalize the loss and do the things that we want, or do we wait and recover? And the market for this particular stock had gone up and down over the last little bit. What they ended up choosing to do was to sell part of the shareholdings that they've got so that they could then move ahead with some of the other wealth building strategies outside of just investing in the company that they're working with, and freed up enough cash to cover tax obligations on any sales, as well as getting a nice property purchase in place and having a little bit left over to start a small share portfolio, and waiting then to see what happens with the recovery of the shares to get ideally closer to the price that they previously were at. So I reckon that there'll probably be a few people in that broader position or facing with those challenges. So hopefully you can learn a little bit from that experience. Our money mistake of the month was a client that was suffering from a bit of limiting beliefs, holding back big financial decisions, and specifically around purchasing a property. We had this client that had been saving for a long time, had built up a significant chunk of savings, enough to essentially buy the property that she wanted outright, or very close to outright. But the fear of taking that step and taking that leap and putting the money on the table was almost paralyzing. And this is a drawn out process over a long period of time that we're having all of these conversations. We knew that the strategy was solid, but still just had these beliefs that were holding her back from pulling the trigger and executing on this strategy. Unfortunately, the downside of that was that there was a significant delay in the property purchase, and then she's missed out on some upside because the property market has run over that period of time. Now, the silver lining is that she's still financially secure and plenty of time and money to do what she wants to do. But through conversations, we realized that there was sort of an almost unfounded limiting belief stopping her from doing what she wanted to do and knew that she needed to do. So how we tackled that, because it is hard to escape our psychology when you're making these decisions or struggling with bigger decisions, but we just ran through all of the scenarios, what could go wrong, what could go right, but in particular, what could go wrong, and how are we addressing those, and how are we protecting her against those, and ultimately put in the position to pull the trigger on the property, and really excited that she's now in the works of making that happen. Ties in with the money hack of the month, which is actually a similar sort of, I was on the mindset theme when I was putting this together, but similar situation, different person that was looking at leaving a company, again, a big tech company that they've worked in for a long period of time, built up a significant amount of wealth, assets and shares in, and looking to move to, they were sort of a bit, they're crushing it in their role, but just a bit bored with what they were doing and wanted to move to a company for their next challenge. But that came with a significant drop in their salary, and certainly with it moving to an early stage company that was not currently listed meant that didn't have the restricted stock plans to keep delivering that income or stock income or more assets over time. And a similar sort of approach in a way, in that we unpacked, what were the positives, what were the negatives, what could go wrong, how were we managing those things, and through that realized that actually by moving on, while there was some downsides that we needed to manage, it was what was going to stop him from living a bigger game. So we worked through that, and I think it was an interesting lesson in doing that, that often the things that are comfortable, the known quantities they do feel comfortable. They're comfortable for a reason because they generally involve no or low risk or risk that we're used to. But it's often taking that bit of a plunge, taking a leap that is what allows you to build a bigger game, whether it's taking a leap with investments, making big decisions with your money, something with property, or changing your career or role. Those are the things that allow you to actually live a bigger life. And yes, if we're playing where we're comfortable, that does make us feel comfortable in that moment, but stops you from doing the things that are going to bring you that real happiness and fulfillment. Client success story of the month. This is a really fun one to work on. That we worked with a client that she was a little bit older, recognized that she had a place that had a lot more space than what she actually needed, realized that she did have a chunk of her wealth tied up in property that she wasn't really utilizing to its full advantage. So decided to downsize her property, and that freed up a whole heap of capital that we could then look to invest the money with to drive a passive income. And she got to the point where she can now essentially retire. Not that she's really old enough to do that, or that she wants to retire or is going to retire, but she's unlocked the value from a property, taken advantage of good timing from a market perspective, and then invested that money in a smart way without too much risk, that has allowed her to create a passive income and essentially now be working for enjoyment and for a hobby. So guys, I hope you found that helpful. That's our best of the month. Look, guys, if you're getting value out of that, would love if you could share the love with anybody else that you think would find value. And yeah.